It's great to welcome to the program today Grace Blakeley, who is an economics commentator at the New Statesman and also author of Stolen: How to Save the World from Financialization. Maybe that's a good place to start, Grace. When we say financialization, what are we talking about?
Sure. Well, I mean, the technical definition is the increasing role of financial markets, motives, actors, and institutions in the operation of the domestic and international economy. Basically, what that means is bigger banks, bigger other financial institutions, hedge funds, private equity, etc., playing a much more significant role in how the economy works as a whole. So it's not just, banking and finance being a bigger part of the economy. It's actually how the growth of those industries changes the way the rest of the economy works. So you have, for example, the financialization of household finances, the financialization of firms and of corporate governance. And that really starts to shift how the entire economy works rather than just kind of being represented by the rise of big banks.
And what's the effect of that on the average consumer in the sense that, I mean, we can imagine in a very general sense, if there are transactions that historically were less frequently connected to the financial industry and over time become more connected, and this could be anything from, as you say, household finance to auto loans to day-to-day transactions using services like Square and Stripe or whatever the case may be. I mean, what is the impact on the consumer of this?
Yeah, good question. So, I mean, in the book, I look at the financialization of firms, of households, and of the state in separate chapters. And the reason it's important to start with firms is that as we've had the kind of financialization of corporate culture, you've started to see a shift in how corporations work. And basically, as a result of the rise of shareholder value ideology, which is this idea that the only responsibility corporations have is to maximize value for shareholders, you started to see those firms kind of extract more out of the economy, pay workers less, and distribute more to shareholders, creditors, the wealthy, etc. And that's kind of created a set of quite big problems in the economy. So it's reduced businesses' investment in kind of building stuff, so in production and investment in things like factories, etc. And it's also reduced wages. So you've seen, in the US, the average worker, has the same purchasing power as they did in 1978. In the UK, we've had a decade of wage stagnation, and that's been a trend that goes back to the 80s, really, when this started stepping up. So you've seen a kind of long-term decline in the share of national income, share of GDP going to workers. But what we've also seen as a result of the growth of the finance sector is that that's kind of been concealed by ever increasing levels of debt, private debt, so credit card debt, mortgage lending, etc., and by rising asset prices, particularly house prices. So before the financial crisis, your wages might have gone down because of financialization of the corporation, but you might not have noticed because your house was rising in value and you're able to access quite cheap and plentiful credit, which allowed you to sustain a higher standard of living even in that context. So that's kind of a big way in which that's affected households. Now, of course, long term, rising levels of debt have not been sustainable, neither of rising asset prices. So that was really kind of integral in how the financial crisis played out in the US and the UK.
Yeah, this has such far-reaching tendrils in a sense to really understand this because we understand what's going on with wages, as you point out. We understand what's going on with inequality, as you point out. But yet, you still hear in the United States anyway, it's particularly commentators on the political right who say, to quote Bill O'Reilly some years ago, the poor still have big screen TVs and cellular phones. And part of that is actually part of the problem that you're pointing out, which is that's not an indicator that things aren't as bad. It's actually part of the indicator that things really are quite bad.
Yeah, exactly. And I think, what you saw really in the 90s and early noughties was accompanied by this massive expansion in credit. So mainly mortgage lending, but also lending, unsecured lending, to credit card lending, and lending to purchase particular goods. It happened at the same time as you had this kind of new wave of globalization, lots of outsourcing, lots of cheap consumer goods available, and this kind of really big consumer boom. And what that did is it not only changed the way the economy works, so obviously you had more people taking out more credit to buy, cheaper goods that allowed them to kind of have a higher standard of living, even in the absence of large increases in their wages. It also kind of changed like the way societies worked, right? So this is partly to do with the fact that taking out lots of debt really changes your kind of psychology as a worker, right? Because, if you're not getting paid very much, back in the day, you might have joined a union and said, we're going to fight for wage increases. If you've got loads of debt, and that's the main problem that's kind of preventing you from having a good standard of living, there's not really a lot you can do about that. It's a very individualized problem. It's not, it's something that's quite difficult to kind of push back against. It creates also a kind of pervasive sense of insecurity, right? Because if you've got a lot of debt and you're constantly on the verge of not being able to pay that, you're much less likely to do something like strike or try and change your job, or really kind of be able to resist the logic of the system in any really substantive way. So yes, that has been a problem for the economy because people are taking out too much debt, often very high interest rates, which is limiting their spending power, and which will become a really big problem when the economy turns, which in the US it likely will in the next couple of years. But it's also created a particular set of political and social problems as well.
Yeah, we've talked before about how the system, in a sense, is designed to prevent people from having the wherewithal, resources, and time to go and really do the type of protesting that would change the system. Because if you don't have sick time, or if you can't afford to take a day off, or if you can't afford to travel to where the protests are, that is the system itself preventing you from changing the system. And in a way, the companies that make money off of making credit available are also providing a means to artificially inflate one's standard of living such that they might be less inclined to go and protest because they're like, hey, I still have stuff in the end.
Exactly. And this whole model, in the book, I talk about privatized Keynesianism. So, the Keynesian settlement was when the state would step up and say, when the economy turned, it would increase government spending. It would provide, basic necessities that you need to live, that you could draw on if you didn't have a job. But since the 80s, we've seen that kind of system of state support replaced with basically, okay, if you can't afford something, take out debt. Whether, in the US, it could be medical debt, it could be student loans, it could just be, debt used to go on holiday or whatever. So you've really seen a kind of individualization of economic relationships whereby, it's on you as the individual to manage your debt, manage your assets, make sure that you are saving enough for retirement, that you're, insured, that, you've got enough to pay for your education, etc., rather than the burden of paying for that being kind of shared equally amongst everyone. As you say, the more individualized the economy is, the harder it is for people to kind of engage in collective action and actually see, we're the majority here. People who live off work far outnumber people who live off wealth. And actually, if they pushed back against the system, then there would be real change. And that's obviously why in the US, there's such concern about, the rise of socialism, right? People are now starting to push back against this really kind of, terrible free market ideology that's caused so many problems. But it's taken a while, and it's still taking a while for people to actually realize, we have the power to change this stuff.
So in the US, even among people who believe that the degree of inequality is a problem, there is not wholesale agreement about how it should be fixed. There's progressive income taxation, for example, but we know that doesn't include people whose income ends up coming disproportionately from capital gains, for example. There is discussion of inheritance taxes. Now in the Democratic primary, there's the discussion of different types of wealth taxes. Elizabeth Warren has proposed one. Bernie Sanders has talked about one. Do you have strong feelings about the policy proposals that you think would not just most effectively, but in the sort of systemically most healthy manner, reduce income inequality and wealth inequality?
Yes, absolutely. So the wealth taxes idea is a good one. It's something we're looking at in the UK as well. It is really important because that division that I spoke about between people who live off work and people who live off wealth is starting to become much starker. So rather than just looking at income inequality, which, as you say, doesn't necessarily take into account the ownership of assets, if you look at wealth inequality, in the UK, wealth inequality is doubly as high as income inequality. And you have similar, if anything, it's more extreme in the US. So wealth taxes are a really important part of this. And that can come in the form of, taxes on financial wealth, so on ownership of, well, on capital gains, as you said, on dividends, but also, property, people who own multiple homes or landlords, etc. Taxes on those assets are really important. But in the UK, we're also looking at a kind of much wider set of reforms to ownership itself. And we've got, for example, the idea of an inclusive ownership fund with the Labour Party in the UK, which is the idea that workers would be given a kind of steadily larger portion of shares in the companies that they work for, up to about 10% of the value of the entire company, which would allow workers to kind of both own the companies, a part of the companies that they work in, and also engage in the governance of those firms. We're also looking at increased state provision of things like housing, so social housing, and of actively nationalising some entities, like, for example, rail, utilities, etc. And what that would do is that rather than kind of waiting for those who own all the stuff to get very, very rich and then taxing it, if we all kind of collectively, socially own resources together, say if they're nationalised or if it's a worker cooperative, then when the economy grows, everyone automatically gets better off. And this kind of both helps to reduce inequality, but also it helps to kind of democratize the economy. You're really trying to extend the principles of political democracy into the realm of the economy by saying workers should be playing a much more significant role in kind of owning and running the firms that they work in, because they know what's going on the ground. And firms that do this sort of stuff often end up being much more productive.
So to bring this around a little bit to the current situation and what some believe is sort of a quickly approaching global recession of some degree, is there anything right now that reminds you of the phase right before the 2007-2008 crash? One of the things that does not seem similar is that at least I've not identified a particular market bubble that may be about to collapse, but I'm completely willing to have my mind changed as far as that goes. But what are the indicators you're looking at, and what's your general sense?
Yeah, so I mean, we are definitely within the next couple of years heading into a coordinated global recession, because the US is likely to go into recession within a couple of years. The UK probably before. A lot of it will depend upon Brexit. And Europe is already teetering on the brink of a recession as we speak. And part of that has to do with just the dynamics of the business cycle. So we get a recession, we get a kind of downturn in growth every 10 to 15 years. And, it's since the financial crisis, we haven't had another recession. And so we're kind of due one today. So there's that. There's also the issue, lots of issues around kind of financial stability and kind of issues around the financial system. So if you look at China, for example, there is kind of a big debt bubble there. And that's potentially causing could potentially cause some instability in the coming years, especially as growth slows in that economy. If you look at the housing markets in Australia, Canada, a couple of other parts of the world, you're actually seeing similar dynamics there as you did before 2007 in terms of rising mortgage lending, the securitization of that debt, and that being sold internationally. So there are kind of pockets of concern. There's also corporate debt in the US, very, very, very high and quite unstable. And there are kind of, sets of problems around the stability of the financial system, with issues that haven't been resolved really since the financial crisis. So what we're really likely to see over the next couple of years is a coordinated global downturn in growth, but that may link in with some of these other problems of financial instability to create particularly bad crises in certain parts of the world. Particularly, China, the US to some extent, depending on what happens to this corporate debt bubble, and also Australia, Canada, places that haven't yet had their housing bubble.
What, if anything, can be done to mitigate the seriousness of it? Or is it really that nothing can be done and it has to be ridden out?
The problem that we have today really is that we have already, monetary policy, so interest rates are already about as low as they can go in most parts of the world. In the US, they've risen a little bit, and that's at least partly why you're starting to see some of these problems emerge, because it's made the debt that a lot of these corporations have more expensive. There is scope to reduce interest rates in the US, but in many other parts of the world, monetary policy is about as loose as it can be. So it'll be much more difficult to kind of alleviate the impact of this recession when it does come around. And that's also the case because we've had obviously this program of quantitative easing, which has been an attempt to loosen monetary policy even more, even when interest rates were effectively at zero in many places. And that hasn't been wound up. The US started to wind that up, and it's causing some real instability in financial markets in the US. So it looks as though we'll be going into another recession with big central bank balance sheets, so central banks owning a lot of assets still through the QE program, and relatively low interest rates, which doesn't give you a lot of leeway to be able to cut interest rates or potentially do even another round of QE, right? I think there's also this other issue of after the last recession, governments stepped back from using fiscal policy to expand the economy, so spending and taxes, because government debt was relatively high. Now, government debt is still relatively high, at least partly because we haven't seen that much economic growth in many parts of the world over the last kind of decade or so. So really on a lot of metrics, governments are going to be really constrained going into the next recession. And we might start to see some unconventional things being done by government. So a lot of people are talking about helicopter money. This is the idea that you can kind of create money to give to households to boost spending. Something that I write about in the book is the idea of a debt write-off. So writing off some of this debt that's constraining people's incomes in the US and the UK and other parts of the world.
Absolutely fascinating and not particularly optimistic, but that is the reality. We've been speaking with Grace Blakeley, who's an economics commentator at The New Statesman. You can check out the book Stolen: How to Save the World from Financialization. Grace, I really appreciate your time today.
Thanks for having me.